My guest today is David Sillaman. David is the founder and CEO of Easy Do It, a real estate opportunity zone fund creation company in Virginia that, according to David, has built 1/6 of all real estate opportunity zone funds in America, totaling $16 billion in raised capital. David is a member of the Forbes Real Estate Council and regularly speaks on Opportunity Zone at Opportunity Zone conferences. So I wanted to invite David to the podcast to share his insights and knowledge about opportunity zones, what they are, and how real estate investors like you and me can benefit from them. David, thanks so much for joining us today.
Sure, absolutely. Thank you. My honor.
I would love to start just by learning a little bit more about your background in terms of how you got into becoming an expert on Opportunity Zone. Like, what's your story for how you got into this space?
Well, I built a business once before on a government program, the Hemp Heart program. And I, just kind of understood how the metrics, kind of basically not even the metrics. I would really more or less say like how things were going to unfold, right? And nothing ever unfolds from the government in just a really clean one done. Here you go. We've given you like a Picasso. Like when you look at how this program unfolded, we got to get 4.5 pages, right? I mean, it's now up to 900 pages of tax code, but we originally got started with 4.5 pages. And when I looked at it in a context setting of the entirety of the TCJA, this was added into. And when you go through that, 800 pages and you start to get a picture that gets painted, that it really kind of, if you've ever done startup or if you've ever been in business, it really kind of gave an easy understanding of how to go about the fundamental mechanics of it. There really isn't anything new about it other than the fact of all the tax benefits and the intricacies of how to play the game. But setting up the game has been established since the 30s and 40s. So, it was just something that I looked at and I said, okay, there's going to be a yield curve in this thing that it's going to go like this and then shoot straight up. And where am I going to fit in that? And I happened to be involved in a hotel deal in Florida. I got involved in the deal in May of 2018. May of 2018. Well, in April, the IRS did the announcement, and then in June, they gave the 4.5 pages, the IRC 1400 Z2A. By July 9th, I had opened up the second opportunity fund in the country. All we simply did was take the real estate deal in hand. It was just happened to be, all the parameters for how the deal was structured met the initial guidelines, and it was off to the races as an OZ fund. And with having set up the second one in the country, that then led to starting with small conventions, and then they got larger and larger and larger, and then they started going national, and then it just kind of started snowballing. And then it went from, if you did one, well, what else is it applicable for? And then I was very, very blessed to meet with just an amazing, amazing tax guy. His name's John Hewitt, Liberty Tax, Jackson Hewitt, H&R Block, that guy. And, he was interested, in looking at from a business standpoint, what the application was or the potential application. This was back before we had anything, before the second tranche of guidelines that came out in May for businesses, before the October guidelines came out in 2008. This was before all of that. And he just was a pioneer in looking at saying, hey, there could be a usage for this for business. And then it just started snowballing from there. And then it led to us doing the first business fund. And once you kind of did the second fund in the country, you're kind of promoting that. Now you've done the first business fund in the country, you're promoting that. It just kind of snowballed. And we've just been really diligent in just really kind of wanting to build out a safe way for this space to grow in a healthy manner. And so we've gone more into relationship focused and more transformational, because we see the program being incredibly transformational across the country. But that's kind of how we got started.
Got it. So just so I understand and so our audience understands clearly, so is that to say that opportunity zones as a concept precede the TCJA, the Tax Cuts and Jobs Act, but the Tax Cuts and Jobs Act actually introduced a lot of the tax benefits and things like that? Or is
No. The when you look at the opportunity zones themselves, okay, they're extensions of existing low-income census tract CDFI tracts. And then there was add-ons, each localities did through the state level, et cetera, went up the food chain, right? But what I was talking about earlier from the 30s and 40s was from a structural standpoint. This is not just a program that is a tax where it's an IRS program. It's, there's a lot of confusion in that, in the world of opportunity zone funds, you just simply fill out a self-certification form and that's it. Well, that's not the reality when you're raising money. You've got the Securities and Exchange Commission that gets involved with, you've got to file Form Ds. You've got to know what type of reg offering that you're doing, what type of documentation that goes along with that. But all of those rules on the mechanics of raising money and the precedents that people have been following for decades now has all been in place. This is, if you follow that same type of mechanical structure, all you're doing is just understanding the rules of the quote game at that point, right? Because it's a tax program, how it benefits the investor, but it's money that's flowing in one entity out into others.
Gotcha. Okay, so with that in mind, what is the 2-minute sort of quick summary of what opportunity zones are in the first place, just to level set? So where do they come from? What's their purpose? What are the tax benefits to investors? And at a very, very high level, before we get into details, how do they work?
All right. So at a very high level, the idea is this is a job creation program that was going to look at real estate and business for the purposes of creating short-term, long-term jobs. The idea is that we can circumvent government and just allow private investors to directly invest in projects, real estate projects and businesses, and they get very specialized tax advantages. For example, as an investor, I get a 10% step up in my basis. Well, first and foremost, I get to defer whatever I pay tax. If I do an investment today, I'm deferring paying tax on that from 2020 tax season to 2026 tax season. So no tax today, so I'm pushing it off to tomorrow. When I do pay the tax in 2026, I get a 10% step up in basis. So if I put $100,000 in, I'm responsible for tax on $100,000, and I only pay tax on $90,000. The real kicker, though, is, and that's at the 6-year mark. At the 10-year mark, you get a full step up in basis to fair market value at time of exit. So what that means in real simple terms is if I bought something at $1 and it rose to $5, that $4 difference, that gain, I pay no tax on at the end of the 10-year period.
Got it. So were opportunity zones created? Were they birthed by the Tax Cuts and Jobs Act as a concept, or did the Tax Cuts and Jobs Act just make them now a lot more attractive?
Well, what the Tax Cut and Jobs Act took what was a bipartisan supported concept and made it into a reality. There you had, groups like EIG, for example, Economic Innovation Group. Steve Glickman was a huge, Shay Hawkins. These are figureheads that are in the space from a legislative standpoint that helped to be able to craft and get it to the point to where, we had that bipartisan support in the TCJA, and then ultimately to get it signed by the president. Got
it. Okay, cool. So where are these opportunity zones located, and how do they get selected? Who decides?
Okay, so first and foremost, the location answer, there's approximately 8,700 plus opportunity zones in all 50 states, across all 50 states, Guam, Puerto Rico, and the U.S. Virgin Islands. How they got selected was, again, they used low-income census tract data. They used the CDFI census tract data, and then they also had input from locality agencies, and then also from the state governor and the state CEOs. And what they did is each state filed with the Department of Treasury saying, hey, these are our zones. And, that's kind of what they identified on a state by state level as, the areas for need.
I see. So in each state, are the zones essentially decided by the states themselves? The federal government doesn't have a say in that, or are there?
Yeah, it was at the state level that they were submitted to the government for the approval at the Treasury level. So if the state wanted to, let's say we've got a redesignation of a zone, right? It's going to have to go through a process back to resubmitting new zones, stuff like that. So but it originated at the state level and executed at the federal.
So I see. So it sounds like the idea is that a state government will look at its borders and say, well, where do I want to encourage or incentivize real estate development to drive, better community and economic development, jobs, et cetera, and they'll try to get those geographic areas approved as opportunity zones. Is that kind of the rough way to think about it?
That was the crux of it. Yeah, they looked at localities and were like, okay, the median income is below par, standard cost of living, all the stuff where they're looking at saying, okay, we've got a lower income populated community. And there are some outliers. I mean, in every state, you've got, definitely pockets that, you kind of scratch your head and you look at it and say, well, how'd that get in there, right? And they're just the diamonds. But in those lower income type of communities is where the idea is saying, okay, from a real estate perspective to hopefully help everybody across the board with new development, bring new, spur economic growth, the jobs from a business perspective, being able to give those businesses in those lower income communities the ability to have access to capital that they might not otherwise have access to.
I see. Are opportunity zones coming online all the time, or was there like a deadline? And after
no. What you've got is you've got a distinction between what are the zones and then what you've got are funds. And the funds themselves are what's coming online, where you're getting basically an opportunity fund market space that's beginning to develop. But the zones themselves have been preset. They're pre-designated. They may do an adjustment later on, or they may add something where the states can periodically readjust them or submit for readjustments. But the zone is just simply the designated area. That's it. It's the entry point into all of this, especially for real estate investors, is through the OZ fund level. That's the front door to the program. That's the bridge in.
Got it. Okay, so the geographic areas are not gonna. We're not gonna expect that they change too much going forward.
I will see minimal. I think we'll see some, but I don't think it's going to be such a dramatic like today to tomorrow type thing where it's like, okay, that's kind of weird, like huge change. I think what will happen is that as the program begins to go through its reporting cycles and everything, and they can begin to kind of see how it's actually playing out, they'll have room for adjustments that way. So we'll see it kind of shift a little bit, but I don't anticipate like massively.
Perfect. So is there a tool or a map where people can go and actually see where the zones are and see which ones are near them and which ones are in other places that investors may be interested in investing in?
Yeah, there's a lot of resources. I'll recommend ozfunds.com. I know that we've got a map on there, for example, where you can pop an address in and it'll tell you whether it's in a zone or out of a zone.
Okay, perfect. All right, so let's jump into a little bit more in detail of the rules and benefits of how opportunity zone funds work. So first question I wanted to ask is, I heard that you can't just like put any type of money in there. It has to be like capital gains funds that actually have to be invested. Can you speak more on that? Like what kind of money must be invested to be eligible for this program in an ozone fund?
And that's a good distinction, that word eligible, right? Because you've got certain tax benefits, and those tax benefits, as it's written right now today, are only applicable to capital gain investors, people who have realized some sort of a capital gain, and then they've got a 180-day window to make a decision to take advantage of the program or not. In real estate cases, a lot of those you've got a little bit different than a 180-day window, because you haven't until the end of the year to start your 180-day calendar based on a real estate K1. So real estate has a little different for those type of investors. But at the end of the day, whether your time clock starts the moment you realize it or whether it starts at the end of the year, you got 180 days.
Got it. So is that any type of capital gain? So I sell stock in Vanguard Total Stock Market, or I sell a house and I have some capital gain. Either type will be
either eligible. Type. You can sell art, you can sell car, whatever the capital gain comes from.
I see. So earlier when you said you get a 10% basis step up if you hold it for 6 years in the 2026 year's tax filing season, it sounds like that's referring to that piece. What you invested, which would normally have been taxed in full because it's capital gain, is now going to get a 10% benefit basis step up if you hold through 2026. Is that accurate?
Yep. Yeah. That's the idea. Is that you're going to basically defer paying taxes today. You're going to pay a reduced tax rate tomorrow, and then in the future, when you go to fully exit, you'll pay no tax.
You'll pay no tax on the gain above and beyond that.
On the growth, on the growth.
But whatever you put in is still going to be taxed at 90% at that point.
Correct.
At the 10-year mark.
Yeah. If the investment has been made in calendar year 2020.
Got it. So just so everyone's clear about this, because I know it can sound a little confusing. So the process is you sell some investment elsewhere in your portfolio that has some capital gain. You take only the capital gain from that sale and you invest it into an ozone fund. You hold it until 2026 at a minimum, And at that point, whatever you put in will get a 10% basis step up. Then if you hold it through the 10-year mark, any gain or growth above and beyond what you put in, that will be completely tax-free. Have I got that right now?
100%.
Okay, perfect.
Absolutely perfect.
Okay, so then my question is, so for an investor who's interested in investing in an opportunity zone, can they invest directly, or do you have to go through a qualified opportunity zone fund? And
have to go through a fund.
You have to go through a fund.
Fund's the front door.
Okay.
There's no back door. There is no side window to open. It's through a fund. Either you're setting up your own, and you're taking, collecting outside investor money in, because you've got, as an investor into a fund and an investor into a real estate, you've got certain rules that are applicable to you, because you've got an ownership rule. You can't have anything more than 20% ownership in the property as an investor into the OZ fund.
Say more about that.
Okay, so now we're going to get technical. So when you're an investor, the idea for this program is not where, hey, I had a $5 million capital gain. Let me just go set up my own opportunity fund, transfer money from bank account A to bank account B for the purposes of tax, and then I just spend my $5 million according to the program. It wasn't designed for you just to do a transference that way. It was designed for people to put money into funds to then put money in, because the fund is doing all the reporting at that level. So what you've got is an 80-20 rule for investors. All right. If I own property and I'm looking to develop that property, and I own it right now, and I've got capital gains, and I put capital gain money into an opportunity fund, and that money is going to go ahead and collect other money and invest into the development of that property, I'm subject to a 20% ownership rule on that property. I can't have anything more than 20% equity ownership stake in the property.
The fund cannot, or the sponsor?
The investor. So if I'm the investor and I own, property right here, and this fund is going to put money into this property, and if I'm investing my capital gain, starting my own fund for the purposes of putting money into my own project, that's what this is trying to avoid. And that's why you've got that 80-20 rule. I
see. So is it that no investor can hold more than 20%, or just the fund creator?
No. It's that no one single investor in a property, if you own it, if you're setting up your own fund with your own capital gains, and you're using that fund money, your capital gain money, to now develop your project, you're subject to an 80-20 rule. You personally can't own anything more than 20% of the property.
Which is to say that you need other investors to make up the other 80%.
And that's why the fund was the front door, because it takes a collective group of investors, puts it into basically a bridge, for lack of better words. That's all they are, right? Comes in, the fund's got a timeline, it's got to get out the door out of the fund account. So it's just pulling and bridging it, and then going into however the fund is structured, whatever their highlights are for their projects, property, etc.
Got it. Can anyone set up a qualified opportunity fund, or only certain people?
No. This was designed for anybody to be able to take advantage of the program. It's just understanding the intricacies of what's involved in setting up a fund is where people have stumbling blocks. You've got, 3 tranche guidelines, 900 pages of tax code. You've got SEC stuff you've got to take into consideration. You've got blue sky laws on a state level. You've got your entity registration, entity formation, your financial documentation, understanding the private placements. You've got all of that goes into it, and that's where most people get a little leery of saying, I'll just set up my own. They'll typically will hire a professional to set the fund up for them.
I see. Are there any rules or restrictions around what the funds, like what assets the funds are allowed to invest in to qualify for all the tax benefits, or as long as it's inside the opportunity zone, it counts?
Okay, so you've got, first and foremost, you got a 90-10 rule at kind of like a high level ruling, which says basically, generally 90% of what comes in must go back out into opportunity zone funds. 10% go towards anything. By the time that you figure on a net in and everything else like that, you're really looking at about 70% going into an opportunity zone fund of what comes in after fees, stuff like that. So but there's no real rulings. It's designed to either go into investments being made into zone stock, where, one fund is purchasing stock from, let's say, XYZ widget business in an opportunity zone, right? Or a fund is taking a partnership position as an investor into typically a real estate development, because most of the real estate deals are typically, partnership-based structures. So it's taking some sort of partnership position into that, right? Or it's going to directly purchase and own the QOZB property itself. And then that's where you then become subject to the substantial improvement versus original use rules. And then, you kind of get into, okay, basically from there. But most of these, though, aren't directly owning the property themselves. What they're doing is they're making an investment into a partnership, like a development, as coming as a limited partner, or they're taking a stock position into a company.
Okay, so just to summarize, it sounds like you can invest as a partner in a real estate development company. You can invest in, you can sort of buy a physical real estate asset itself, but then that subjects you to substantially improved rules, which I want to talk about in a moment. And then you mentioned this third one, which I hadn't heard of, which is you can buy stock in a company in the opportunity zone. Like you're literally buying, like,
just like you would, like if you bought stock in Facebook, a private company, and you're purchasing shares of their stock.
I thought the point of the program was for real estate development. So if you buy stock in a company that happens to be located in the zone, how is that real estate development?
Yeah, the point of the program was never real estate development. I know we're on a podcast talking about real estate development and how real estate plays into this. The point of the program was never real estate development. The point of the program was always job creation. And so when you look at how the program was originally, when you look at the IRC 1400Z2A and how it's written, it talks about the very first thing that you talk about investing into is zone stock. So this was always designed to spur capital investments, both into opportunity zones for the purpose of creating jobs. You can't leave out business and out of that equation.
I see. So that makes a lot more sense. So if you invest in stock in a company, you're basically injecting fresh capital in the business that can then be used to expand, grow the business.
Hire, yep.
If you invest in a partnership in a real estate development company, presumably that partnership or that company is going to then redevelop the community, which might attract new business, et cetera. And if you buy a real estate asset directly, then you have to substantially improve it, which essentially has the same effect. I guess all these things are pointing toward a community development and hence job creation.
Yep. And you kind of have like a left hand, right hand where both support. The business injection at the stock level is typically a little bit more longer term job creation piece, where the real estate piece is typically a little bit more the short term. So you're getting the quick injection, and then you're also getting the longer stabilized injection as well. At least conceptually, that's the idea.
Gotcha. Okay, cool. So if you do buy a physical real estate asset, or the fund does buy a physical real estate asset in the opportunity zone, now you're subject to substantially improved rules. And could you comment a little bit about what does substantially improved mean quantitatively, and like over what time frame are we talking about that you have to meet these criteria?
All right, so the substantial improvement is going to be your purchase price minus the cost of land. So you're basically your basis into it minus the cost of land plus $1. So you got to do 100% of your basis plus $1. Okay, that's a substantial improvement unless the property qualifies as original usage. And there's been some recent update guidelines like 2 weeks ago on the original usage and kind of narrowing down what that looked like and making it a little bit more easier, where after a year of like vacancy, it could be reclassified as original use to avoid the substantial improvement aspect of it. There's a 36-month safe harbor provision for real estate. There's a 64-month, I think, safe harbor. I got to double check it. I know it's like a 64-month. Safe harbor provision for businesses. But with real estate, basically the fund itself has got an initial 180-day period when the money comes in, and then it's got an additional safe harbor of another 31 months to deploy that money into the project, so it doesn't all have to just go in one time.
So the 31 months is the deadline before which you have to make all the substantial improvements, or
that'd be the deadline. Yeah.
Gotcha.
Because it's going to be based on the reporting. So, yeah.
What does original use mean?
Original use is like, okay, I'll give you like an example. Let's say that we wanted to invest in a hotel. Okay. Got this nice hotel. It would be easier probably to renovate it and keep it as an existing hotel using it originally. But we're looking at it and saying, yeah, you know what, let's kind of convert this thing into nothing but studios, right? Going from what it was to something different, you've got now a substantial improvement.
I see.
That's a real simple kindergarten level type of example of the idea behind it.
So if you stick with its original use, then you do not have to substantially improve it, or just improve it less?
No, you don't have to substantially improve it at all.
Interesting.
The substantial improvement only comes into if it does not meet the original usage criteria. You're still investing into it, and odds are you're still going to have some sort of improvement. But with the difference between original use and substantial improvement is that substantial improvement has you have to meet X, Y, Z, right? You have to do 100% minus cost, your basis plus $1 to improve it. In order for that property to qualify as an eligible investment, that the fund would then in the future be reporting saying, hey, we made an investment in this property and we improved it and met that threshold. The original use is you don't have that threshold that you have to meet minimum. So that's really the only difference.
Got it. So just to tie it together, so it sounds like if you change the use, you have to substantially improve, and that means at least putting in $1 more than you invested to improving it. So you have to essentially budget twice the amount of money and more. Yep. Part to actually acquire, and then more than that part to improve it. Right. That's if you change the use. If you keep the use the same, there's no such rule around having to substantially improve, but obviously if you want a return, you're probably going to have to.
Like a real estate investor would look at it and say, okay, I'm going to come into like residential real estate investing. I'm going to set up an opportunity zone fund. Me and my buddies, our golfing buddies, we're going to throw our money into a fund collectively together as a partnership. We're going to go buy real estate. Residential, right? Well, they're keeping it residential. The idea is they're going to put a homeowner in there or a renter in there, right? But you're going to go in and improve.
Gotcha. Okay, cool. Are there any other gray areas in the rules that the IRS still has not issued definitive guidance or regulations on that investors should know about?
Well, really, it's not something that I think that would be, at the investor level. It really is just more of still at the fund reporting level. We still got a lot of debate up right now on both sides. We got a lot of legislation bills that are still up regarding opportunity zones, and really just how they're supposed to be reporting. And we're still getting all that. We still don't have we've got the drafts, but we don't even still have the actual finalized, set in stone. Here you go. This is the form. Fill it out. You're late for just the funds to do their first set of reporting yet. That's still in draft mode. So those are kind of like the gray areas, but that's not really something that is concerned to the investor, because at the investor level, the idea is that you're more passive for the most part. It's really a time play than it is anything. And at the fund levels where all the mechanics have to work at. Now in partnership, and if you're coming in, as a general partner, which, you can do as an investor into a QOZB, or into a QOF, you can come in as a investor partner into it if it's structured that way. But beyond that, it's all at the fund level.
Got it. So if you're just a limited partner investor, the rules and how it works are basically set in stone. You don't have to worry. It's more that if you're at the GP level and you're having to deal with reporting, then some of that stuff is still being worked out.
Yeah. And if the fund is structured the right way, especially since you've got a lot of higher net worth investors that are listening. If the fund's structured the right way, even as a partnership, it should still have the third-party custodian or third-party fund administrator that will be handling a lot of that compliance aspect for both the investors and for the fund reporting compliance as well.
Gotcha. Okay. At a macro level, who would you say this strategy, i.e. investing in opportunity zones, is good for, and who is it not good for?
It's great for everybody. The only one that it's really not good for is where if I'm putting basically like post-tax money, I've saved money and I'm putting it into an opportunity zone fund. I can ride the yields up, but I'm going to pay the gains each year on that. I don't get that specialized tax benefit. So that's really right now the only group that is kind of left out of it. If we look at the RIAs, the family offices, the wealth managers, the broker dealers, now with the CRA credits being readjusted for banks the first time in 9 years, we're going to see more traditional outlets be heavily involved with this. So this is going to be this is a rock star program. This is really one of two things. This is either in my opinion, the biggest game-changing, economic-changing tax bill for our country, probably even more so than what the Industrial Revolution was, for what we'll see it, because this has the ability to impact everything, both real estate and business. And when you look at what that reach looks like, you're talking technology, you're talking medical, you're talking innovation, you're talking A to Z for the most part. I mean, even space, for example, as long as space is, the whatever they're manufacturing, rocket is located in an opportunity zone, they can take advantage of the program. So it's got that type of far-reaching. So it's either going to be that much of a landscape change for the U.S., or it'll just be the biggest tax giveaway for investors in the U.S. history. One of the two.
Gotcha. So where can people find out more about different opportunity zone funds out there? Which ones are accepting new investors, as well as like each fund's investment strategy, their portfolio holdings, the credentials of the team, and their track record? Where can people get more information about that?
That's a great question. Okay, so the answer to that is all over the place, because there's not really a true set, like centralized source yet for this. You've got and we're trying to be one of those first pioneers for doing a set resource. We've got a website, ozfunds.com. Kind of easy. That's what you're looking for, an OZ fund. So we're hoping to be able to, have just probably the most detailed directory listing. We're trying to get this launched by the end of the month, actually. But there's a lot of other different directory listings out there. You can search, CoStar Group, for example, if you're into real estate, like Novogradac. The NCSHA for real estate investors, National Council for State Housing Agencies, has got a pretty thorough list of OZ funds. But there's not a real centralized source yet. I mean, you got to think we're only into a market that we had 2018 was basically saying, hey, we're going to give birth, we're pregnant. 2019, with the way everything kind of played out, with the start of January, with going into a government shutdown, into the start of 2019, to not getting the final regulations until the end of December of 2019. So we're still kind of, 2019 was like 2018's, hey, we're pregnant. 2019 is we just gave birth. This is the first real, 2020 will be the metric year.
Got it. Okay, so if you're an investor who's interested in potentially putting money in an opportunity zone, are you just left to the Googles or the ozfunds.com website for looking up which funds are actually accepting new investors and what their strategies are?
Yeah, unfortunately, right now, I mean, that's just what you're left up to. They're private investments, so they're not going to be like, let me go search the Dow or the Nasdaq or something crazy like that. Or there's one that's on the pink sheets. One. So it's really probably one of the better resources is, and I think that what municipalities are trying to do right now is really kind of begin to get an idea of who's operating in the OZ space in their localities, from a fund level, from a project level. And, so at the state and localized level, I know a lot of resources are being developed. This year, we'll see a more clear path for investors. They're having to rely on their CPAs doing research. Far and few of these are brokered out. You've got a couple big dog players like a Morgan Stanley, for example. I know that they've brokered like $2 billion worth of OZ funds already. So you've got a couple of big dog players that you can get into that way. I know that PNC Bank and Woodforest National Bank, that bank in Walmart, for example, just set up an OZ fund. So you'll probably be able to get in, some of that kind of stuff. There's a few of them that are like Reg A offerings where you can find them out there on like those equity crowd raising type platforms. But most of them are just you're Google searching and you're just going through directories and dialing for dollars.
Gotcha. Are you seeing a lot of institutional money flow into this, like traditional private equity firms or investment funds that are pouring money into opportunity zones, or is this really geared toward retail investors?
No, this isn't geared towards any one set type of investor. I mean, we got a $6.4 trillion 2017 market cap of capital gains between corporate and individuals. So that's a huge, huge, window from here to all the way down here where we're at right now, where we've had about, I've seen some reports of size like 25 billion for 2019 that flowed into opportunity funds, where when we looked at 2018, we had about 4.5 billion that moved into OZ funds. So huge step up, but nowhere near where it will be. The institutionalized investors, broker dealers, you got to understand that they're still private. These things have no prior performance history. You're trying to run a FINRA 1022 on this thing, or due diligence underwriting on these OC funds. What do you get? All pro formas for the future. So you've got a few outlets like Walker Dunlop, for example. They're doing a lot of stuff with trying to give more credence and credibility to projects around with OZ funds. But that's what we're kind of seeing right now. And the delay in guidelines didn't help things either.
I see.
Getting finalized stuff until December for an investor is like, well, I've been waiting all year long.
So are you actually seeing institutional capital pour into these funds, like the Blackstones of the world, et cetera?
Oh, absolutely. Blackstone has set up their own opportunity fund. Griffin Capital's got an opportunity zone fund. Actually, I've got a list of a bunch of them here. I can't pull it up right now, but I got a list I could send you. But yeah, you're starting to see this year will be a big year all the way around, between banks, between traditional brokers, RIAs, family offices. Last year, we saw a lot of like family office money that were holding like summits and bringing opportunity zone funds and opportunity zone speakers to their summits, trying to help educate their family office money. But last year was kind of like I said, it was a birthing year.
Awesome. This has been super insightful in helping folks, I hope, understand a little bit more about how this program works and how the tax benefits work, and how to consider whether this might be a sensible part of your investment portfolio going forward. David, where can people find out more about you and your work and services?
They can visit us online at easydoit.com, and that's EAZYDOIT.com, or ozfunds.com, ozfunds.com.
Perfect. Well, we'll link to both of those in the show notes. And thank you so much again for taking the time to share your experience and insights with us on this important investment topic.
It's been an honor. Thank you so much, Andrew, for having me on.
Take care. Cheers.